Hello class, and welcome to the video lecture for Chapter 15, Accounting for Leases. As you learned in the first two learning objectives for Chapter 15, leases are accounted for as either capital leases or operating leases. Capital leases are accounted for as if the lease agreement transfers ownership of the asset from the lessor to the lessee. We'll look at the criteria for classifying a lease as a capital lease soon. Operating leases are accounted for as rental agreements. Let's review some of the provisions that might be in a lease contract which affect the accounting of the lease. The first is a cancellation provision. If a lease is designated as non-cancelable, it can be canceled only as the result of a remote contingency. That means it's extremely unlikely that a condition warranting cancellation will occur. Also, a lease is designated non-cancelable if the penalties are so costly it's unlikely the lessee would ever cancel. Non-cancelable leases are accounted for as either capital or operating leases. Cancelable leases are accounted for as operating leases. The next provision is a bargain purchase option, which means the lessee is given the option to purchase the asset at the end of the lease term. The option is considered a bargain if the purchase price is considerably less than what the fair value of the asset at the end of the lease term is expected to be. Recall from the last slide that non-cancelable leases are accounted for as either capital or operating. If a non-cancelable lease has a bargain purchase option, it's accounted for as a capital lease. Now let's review the significance of the lease term. The lease term is the time period from the beginning to the end of the lease. It begins when the leased property is transferred to the lessee. It ends at the end of the fixed non-cancelable lease period, plus all renewal option periods that are likely to be exercised. A renewal option that is likely to be exercised is called a bargain renewal option. If the lease is cancelable, lease term is irrelevant because the lease would be accounted for as an operating lease. Residual value is the market value of leased property at the end of the lease term. Residual value can be guaranteed or unguaranteed. If it's guaranteed, a residual value is stated in the lease contract, and at the end of the lease term, the lessee must pay any difference to the lessor if the actual market value is below the guaranteed residual value. If the residual value is unguaranteed, the lessor and the lessee must still estimate the amount for use in computations associated with accounting for the lease. Minimum lease payments are the payments required by the lessee over the lease term. If there's a guaranteed residual value, that amount must be included in the minimum lease payment. Executory costs are charges for items such as insurance, maintenance, and taxes paid by the lessor. These are usually accounted for annually. In this example, we have the lease of road equipment. The lease has a 3-year term, and monthly payments of $3,000 per month are required, which includes $500 of executory costs. At the end of the 3-year period, a residual value of $10,000 is guaranteed. The total minimum lease payments are $100,000, which includes the monthly payment exclusive of executory costs and the guaranteed residual value. Presented here are the present value computations from the textbook, which are meant to demonstrate that the $2,500 monthly payment and the $10,000 guaranteed residual value will cover the fair value of the road equipment. In reality, the lessor would take the fair value and the lessor's implicit interest rate to find the monthly payment. I'm going to demonstrate how that $2,500 payment was derived using a present value table. A financial calculator or Excel would be much more accurate, but a table works just fine for demonstration purposes. So the lessor decides to lease road equipment that has a fair value of $75,269, and they desire a 12% rate of return on the lease. The lessor needs to determine how much to charge the lessee. Since the lease is for 3 years and payments are required monthly, we have 36 periods at 1% per month. This example assumed payments would be due at the end of the month, so we use a present value of an ordinary annuity table. We find the intersection between 36 and 1%, which gives us a present value factor of 30.1075. In the textbook presentation, you saw that the authors proved the amount by finding the present value of 36 $2,500 payments. This can be found by multiplying the payment of $2,500 by the present value factor of 30.1075. The payment can be found in the same way, except you take the fair value of the asset to be leased and divide it by the present value factor. One word of caution: be attentive to the number of periods and the interest rate. Some payments are to be monthly, some annually. Some payments will be due at the beginning of the period, which is an annuity due, and some will be due at the end of the period, which is an ordinary annuity. Always make sure you convert an annual rate given into a monthly amount if needed. Two kinds of interest rates must be considered in accounting for leases. The implicit interest rate is the rate used by the lessor in calculating the desired lease payment. It's essentially the lessor's desired rate of return on the lease agreement. The incremental borrowing rate is the rate at which the lessee could borrow the amount of money necessary to purchase the leased asset. While a lessor will only use its implicit rate in calculations from the lessor's point of view, the lessee might use either the implicit rate or the incremental rate. Here's a practice problem to try, so pause the video, work the problem, and resume the video when you're ready to see the solution. Practice problem 15.2 is a matter of finding the present value of both the $1,000 monthly lease payments and the $10,000 guaranteed residual value. The total present value of the minimum payments is $29,119.40. Four general criteria must be considered when deciding if a lease is to be classified as capital or operating. The first is transfer of ownership. While a lessor might allow the lessee to use a leased asset, it might not transfer ownership. Transfer of ownership might be included in the lease agreement, in which the lessor transfers ownership of the leased asset to the lessee by the end of the term. The next criteria to consider is whether or not the lease agreement has a bargain purchase option, which we already covered. The third is the lease term. You will need to determine if the lease term is 75% or more of the economic life of the leased asset. The last is the present value of the minimum lease payments, which must be compared against the fair market value of the leased asset to determine if the payments are 90% or more. The lessor has two additional criteria to consider. First, the lessor must determine if actual collection of the lease payments is reasonably predictable. The second is that any costs yet to be incurred are known and can be reasonably estimated. For example, a lessor might lease out a building under construction that still has work to be completed. Here's a summary of how to classify a lease based on the four criteria. First, let's look at it from the view of the lessee. If any one of the general criteria is met, the lessee classifies the lease as a capital lease. From the view of the lessor, if any one of the general criteria is met, and the two revenue recognition criteria are met, the lessor classifies the lease as a capital lease. If a lease is classified as capital for one party, don't assume it has the same classification for the other party. The present value of the minimum payments can sometimes cause the perspectives of each party to be different. Presented here is a summary of lease situations and their classification according to the criteria. Let's start with lease 1 from the lessee's perspective. Title doesn't pass, and there's no bargain purchase option. The lease term is not 75% of the economic life of the asset. The lessee does not know the implicit interest rate. This means the lessee must use its own incremental borrowing rate when calculating the present value of the minimum lease payments. Using the incremental borrowing rate, the present value of the minimum lease payments are found to be 80% of the fair value of the leased asset, so it doesn't meet the 90% threshold. Since none of the four criteria are met, the lessee does not classify this as a capital lease. Instead, it's an operating lease. Now let's look at lease 1 from the perspective of the lessor. The first three criteria are not met, as in the case of the lessee. However, the lessor uses its implicit rate to calculate the present value of the minimum lease payments and finds this to be 92%. Since this exceeds the threshold, that criterion is met. Before classifying the lease as capital, the lessor must also consider the two revenue recognition criteria. The information states these criteria are met, so the lessor classifies this lease as a capital lease. Take a moment to review the rest of the examples, analyzing each situation so you're comfortable with the lease classification criteria. Now let's review some examples, starting with accounting for leases from the perspective of the lessee. Here we have an operating lease. The lessee records a debit to rent expense and a credit to cash each time it makes a lease payment. Sometimes the terms of a lease will require unequal payments, which requires special accounting treatment. In this example, we have the lease of an aircraft in which $150,000 per year is due for the first 2 years and $250,000 per year for the next 3 years. That's a total of $1,050,000. That $1,050,000 is to be recognized equally each year, even though the cash payments are different. We need to recognize $210,000 each year. In years 1 and 2, the lessee recognizes the expense of the operating lease with a debit to rent expense of the amount just calculated, $210,000. It then records a credit to cash. However, the cash payment is only $150,000 as specified in the lease terms. The difference is recorded in rent payable. In the third year, the payment is larger, so the rent payable account can be reduced. By year 3, $120,000 has accumulated in the rent payable account, so to reduce that over 3 years, we debit rent payable $40,000 in each of the last 3 years. Now we have a capital lease from the perspective of the lessee. The lease period is 5 years, beginning on January 1st, 2015. The lease is non-cancelable. The payments are $65,000, which includes $5,000 in executory costs. The economic life is estimated to be 5 years, and the asset is not expected to have a residual value. The incremental borrowing rate and the implicit rate is 10%. The first step is to determine the present value of the minimum lease payments. The lease payments, excluding the portion attributed to executory costs, is $60,000 each year, due at the beginning of the year. The number of periods is 5, and the rate is 10% annually. Since the payments are due at the beginning of the period rather than the end, this is an annuity due. Using the present value of an annuity due table, we find the present value factor and can determine the present value of the minimum lease payments to be $250,192. The textbook describes an alternate method of splitting the payments so the present value can be determined using the present value of an ordinary annuity, but I will simply be using the annuity due table. The first journal entry records the lease. This is a capital lease, so the lessee records the lease with a debit to the asset account called leased equipment. The credit is to a liability account called obligations under capital leases. Next we have the first payment, which is due immediately when the lease starts. The executory costs are recorded as lease expense for the lessee, so a debit of $5,000 is the first part of the entry. The remaining $60,000 of the lease payment is applied to the liability established in the first journal entry, which is a debit to obligations under capital leases. Finally, we have a credit to cash for the total amount of the payment. At the end of the first year, the lessee needs to account for the use of the leased asset, just as it would account for the use of a purchased asset. However, instead of depreciation, the use of the asset is amortized. The journal entries are the same as they would be for depreciation, except the account title. In this example, the lessee uses straight-line depreciation, and so will record $50,038 at the end of each year as amortization. The entry is recorded with a debit to amortization expense and a credit to accumulated amortization. Accumulated amortization is listed with the leased asset account on the balance sheet, showing a book value, in the same way a purchased asset with accumulated depreciation would. Presented here is a schedule of lease payments. This schedule gives the accountant quick access to the amounts needed to journalize each year. This schedule also makes it easier to determine how much of the liability is current and how much is non-current. In your homework and on exams, it's helpful to work out a quick schedule like this to answer questions related to the journal entries and classification of the liability. The journal entries we just did reflect the information on the first two lines. The $60,000 debit to lease obligation reduced the lease obligation from $250,192 down to $190,192. Beginning with the end of the first year, since the leased asset is now being used, interest expense must be recorded. Interest is determined by multiplying the lease obligation at the beginning of the period by the interest rate used to compute the present value of minimum lease payments. So at the end of 2015, $19,019 of interest expense has been incurred and must be recorded. The remaining amount of the payment, in this case $40,981, is applied to the lease obligation itself. Here's the journal entry. We debit prepaid executory costs. Remember that in the first entry, at the beginning of the year, we paid the $5,000 executory cost for 2015 up front and recorded debit to lease expense of $5,000. So that $5,000 expense is being accounted for already in the 2015 income statement. Here we're accounting for the executory costs of 2016. Since 2016 hasn't happened yet, we record it as a prepaid asset. In 2016, we'll just credit that account and debit lease expense. Next, we reduce the liability for the amount we determined on the schedule with a debit to obligations under capital leases of $40,981. Then we debit interest expense for the amount we determined on the schedule, and finally we credit cash. Here's a partial balance sheet. Notice the presentation of the leased asset with its accompanying accumulated amortization account. Now take a look at the current and non-current liabilities. Refer back to the schedule while you look at this. The amount reported as current can be found on the December 31st, 2016 line of the schedule in the principal column, because that's the amount of the liability that would be paid in the next year. Any remaining amount after that payment is non-current. To emphasize the importance of determining how much of the lease liability is current versus non-current, pause the video here and determine the current and non-current portions that would be reported on the 2016 and 2017 balance sheets. Resume the video when you're ready to continue. The 2016 balance sheet will report $49,587 as current and $54,545 as non-current. The 2017 balance sheet will report $54,545 as current and nothing as non-current. Now we have an example with a bargain purchase option. These are the same facts as the previous scenario, except the lessee has a bargain purchase option of $75,000 and the economic life of the asset is increased from 5 years to 10 years. Again, the first step is to determine the present value of the minimum lease payments. Remember that when a bargain purchase option is present, it's to be included in this calculation. We find the present value to be $296,761. Here we have a payment schedule. The portion of each payment that applies to interest and the portion that applies to the liability are computed in the same way as in the previous example. The difference is found in the last year. We have one final payment to account for, that of the bargain purchase amount of $75,000. The entries up to the last year are the same, with amounts taken from the schedule. Presented here is the entry for the last year, in which the bargain purchase option is exercised. First, we record the last entry pertaining to the interest expense and the reduction of the lease liability, just as we would have in the previous example. Next, we transfer the leased asset to a purchased asset in the accounting records. We do this by closing out the leased equipment and the related accumulated amortization accounts with the appropriate debits and credits, and establish a new account for the asset as a purchased asset with a debit to equipment. Here's some practice problems to try from the end of the chapter. Pause the video to work on the problems, then resume the video when you're ready to see the solutions. Presented here are the solutions to practice problems 15.7 and 15.8. 15.7 is straightforward. When a lease is accounted for as operating, no asset or liability is recognized, so no entry on the lease signing date is needed. The first lease payment is recorded with a debit to rent expense and a credit to cash for the amount of the payment. For 15.8, we determine the rent expense to be debited each year by totaling the payments and dividing the total by the number of years in the lease term. We credit cash for the amount of cash paid. The difference is either a debit or credit to rent payable, depending upon whether the cash paid was more than the rent expense or less. Presented here is the solution to practice problem 15.9. The present value of the lease payments is found by multiplying the $3,000 payment by the present value factor for 10 periods and 10%. On the lease signing date, the lease is recorded with a debit to a lease asset account and a credit to a lease liability account for the present value of the payments. The amounts to use to record the first lease payment can be found by creating a schedule. The portion of the payment applicable to the interest expense is the lease liability at the beginning of the period, multiplied by the rate used to compute the present value. The remaining portion of the lease payment is applied as a reduction to the principal. In addition to the payment, amortization must be recorded. Using the straight line method, the amortization is found by dividing the asset amount to be amortized by the economic life of the asset. Presented here is the solution to practice problem 15.10. The present value of the minimum lease payments includes the present value of the bargain purchase option. The journal entries are the same in form as in the previous problem. Pause the video if you need to review the solution in detail.